everybody. How are you? Thank you so much for joining us tonight. We're so excited to be able to go over a few things with you. My name is Denise O'Reilly, and this is my amazing husband, Michael O'Reilly. We are married and we're also partners. We are managing partners of Flow Equity Partners, also Flow Equity Fund. And we're excited to talk to you about multifamily today. So we're going to be talking to you about creating multiple streams of income and building legacy wealth through multifamily. I'm going to go over kind of an intro, and then Mike's going to go into the main part of the presentation. All right, so Flow Equity Partners, what is in a name? So flow means so many things to us, and it kind of embodies our core values, which are freedom, lifestyle, ohana, or family, and well-being. And also, when it comes specifically to investing, it's finding lucrative opportunities for wealth through investing. This is us. So I've been in real estate for just about 20 years. I've done acquisition, sales, property management, and I'm involved in asset management, acquisitions, and operations. And Michael comes from a long career as an equity trader. He worked for a large broker-dealer for about 23 years. Together, we own and operate multifamily, so about 1,200 units of multifamily, but we're also involved in boutique assisted living homes here in California. All right, so I mentioned that we are involved in about 1,200 doors, and we focus mainly on the Sun Belt region, Texas and the Sun Belt. So we live in California, but we invest in Texas and the Sun Belt. So they say, live where you want to live, but invest where it makes sense. So why do we love Texas and the Sun Belt? We love that area because there's amazing economic drivers, landlord-friendly, business-friendly. There's great, just amazing population growth. And when it comes to Texas specifically, Texas is very, very growth oriented. And there's a lot of Fortune 500 companies that are based in Texas. Texas is also the #1 U.S. exporter. So there's a lot of big.
I think his game has really matured in a matter of.
So we're just muting some of the people that have joined. Give us 1 second, please.
All right. So here is our basic overview of what we're going to talk about tonight. This is our agenda. So we're going to go over the benefits of multifamily investing, multifamily value-add strategies, multiple streams of income, building legacy wealth, ways to invest, leveraging experienced GPs and sponsors, investment strategies, market analysis and due diligence, financing and capital raising. And then we're going to get into risk management and show you a sample Class B apartment. And then we're going to conclude. We know your time is really valuable, so we're going to try to keep this brief. We're going to try to stay within the 30 to 40-minute range. All right, so without any further ado, I'm going to go ahead and pass this over to Michael, and he's going to talk about benefits of multifamily investing.
Good evening, everyone. So for Denise and I, we started our real estate investment careers about 20 years ago, really. We started with single family residents, and we've had good tenants, bad tenants. We've had water heaters go out, people that have left in the middle of the night, and ultimately the ability to scale and grow to a level that we wanted to be at was pretty challenging. When you go to the bank, you're only going to qualify for so many properties before the bank says you can't qualify anymore based upon your income. And so we love multifamily for the scalability. Obviously, more doors limits your risk, gets spread across number of tenants and number of units, could be a number of properties. So there's that advantage in the scalability aspect of multifamily investing. We love the tax advantages. 2017, there was a Tax Cut and Jobs Act, which allowed investment properties to basically take bonus depreciation through accelerated depreciation. We take advantage of that on all our properties. It's not a direct, tax discount. It's basically a tax offset. So if it applies to you in your particular state, given your particular, employment status, you should definitely contact your tax professional. But multifamily could be a great way to offset some of your tax implications. Definitely on your federal level, just doesn't always apply on the state level. And these properties, although a little bit more challenged as of recent, mainly because of the debt that was available on these type of properties a couple years back. But a lot of the bridge lenders or a lot of the bridge operators that acquired that bridge type of debt, they're having some cash flow issues. There's been some significant run-ups with regards to taxes and insurance. And also just being able to meet that debt service coverage ratio. With all those increased costs, cash flow have dried up on some of these investment properties. However, there's a huge opportunity on the horizon. Some say that we're in the opportunity right now, but within the next 4 to 6 months, we believe that there's going to be a lot of movement in the space. And so that's one of our reasons of jumping on and trying to get people up to speed in our investor database. So another aspect that we really like is the diversification across multiple properties, multiple units, as I mentioned. Just limits your downside risk. And these properties, day one, they're living, thriving businesses, so they appreciate over time. And what we try to look for are inefficiencies in properties that we will acquire. And by looking at those inefficiencies, we hope to be able to not only have the property appreciate, but force appreciation. There's also the passive income aspect. If you are a limited partner investing in multifamily, we started as limited partners, and we still invest in other operators' deals as limited partners. So we like the passive income aspect to this type of investing as well. So within the multifamily space, there's a number of different strategies. Denise will go over it in just a short time here, but the one that we find that we have enough experience in, and there's a number of levers that you could pull in order to get to your end result, is value add strategy. So what we try to do is, as I mentioned, we try to identify properties that have a little bit of inefficiencies in operating. And we try to identify that and be able to bring rents to market, not increased or be an outlier in the market, but just by acquiring at the right price, getting the right debt, and then increasing to the rest of the market. It allows us to really push values and give investors a substantial return on their money. So we increase rents by doing unit upgrades. We obviously want to make the properties more attractive, bring them up to date. A lot of these properties, in many cases, are classic or vintage inside. We try to reduce our loss to lease. So like I mentioned, we just try to bring rents to market. And then a lot of times the inner workings of these properties, a lot of things can be made more efficient, bringing down some of our energy costs, whether it be transferring over from a chiller boiler system to individual HVAC, solar panels, looking at the efficiencies of those solar panels. And sometimes it's just maintenance. Sometimes it's a new roof that needs to be, with better insulation, needs to be redone. So there's a number of different ways to rework these properties. And then in doing that, we try to make it obviously more attractive to live at these properties. So there could be a number of things. More recently, dog parks, Amazon package lockers with everybody shopping online in the holiday season, playgrounds if there's a lot of kids. And with kids, we obviously want security. Who hasn't experienced, more crime across the US has gone up, especially petty theft. So, we put in new security gates, video systems and such in order to make the properties more attractive.
All right, so this is going to be an illustration of how you can achieve multiple streams of income in multifamily. So this is just looking at a potential portfolio of 3 multifamily apartment investments over the the time of 6 years. So we have a few assumptions that we're going with. Number one, we're investing $100,000 in each deal for a total of $300,000. Number two, it's a 3-year hold, and 3 to 5 years is often standard for value add holds. And then number three, the deals are selling every other year, starting year 3. So property A, we're going to assume it's a 1.8 multiple, which is 80% profit or $80,000. And again, that sells year 3. Property B, we're going to assume a 1.75 multiple, which is a 75% profit, $75,000, which will sell in year 5. And then property C hit it out of the park, and we had a 2.25 multiple, whopping 125% profit, which is more than the original investment amount. So $125,000 profit, selling in year 6. So at the end of the year 6, you see that if you add up all of your profits, that's $280,000 in profit, and plus your $300,000 initial investment coming back to you. So you are walking with $580,000 total, which is an average of a 93% return.
Yeah, that's correct. So essentially what Denise is describing there is as you build your portfolio, you just like a trade in the stock market, you're looking at dollar cost averaging. There's many ways to to diversify. You could diversify on individual properties as you build your own portfolio of investments. You could also invest in a fund which tries to do this and mitigate risk across different assets. And so there's many ways to look at it, but we feel like this safely illustrates some of the targets, realistic targets that have been achieved within this space in the last couple of years. All right, so we believe that multifamily is a great way to build some legacy wealth. Obviously, I just mentioned dollar cost averaging, deferring the taxes, essentially doing what the government would like us to do, which is investing in housing. It's not something that they would like to do. So if we do follow the tax code, invest in and follow these things that incentivize us to get a tax break, we're able to reinvest. And if you reinvest consistently over time, you'll have the ability, the compounding effect, to where multifamily investing basically it can create generational wealth and financial stability for your opportunities for your family. So there's a couple different roles or steps within the landscape of not only multifamily investing, but investing in general. So there's usually the management group, which is made up of general partners. A lot of times there could be a key principal that plays a key role within that group. And then there's limited partners. So limited partners, you're really limited to your downside per your investment in that particular asset. And there are no management roles really as a limited partner. However, you do want to look at the investment, whether it's by batting it off somebody else or just taking the time to actively learn, you learn while you earn in a sense. So you actively take a role within the investment and you learn over time to be able to really look at these properties, look at the underwriting, not only, some of the assumptions that are being made by the GP group, but really having an opinion on whether their assumptions are correct. Understanding what the cap rate going in versus the reversion cap rate on the back end. Are those assumptions correct? Is the GP group basically seeing the market in its totality as the right direction as where it's going? And if not, you definitely have a relationship with somebody on the GP team in order to give your input. And then eventually the key principal role, like Denise and I, we have we've played all 3 of these roles. You basically, you lend your net worth and sometimes liquidity to the deal. You sign on the dotted line, so you have a higher sense of responsibility to the deal and to some of the investors. And the GP is really making, as a team, it's very much a collaboration, but you're making decisions. You're making decisions to the overall direction of the investment. And basically, your GP team, you should be leveraging their experience. We leverage our team's experience. We have the whole way, including when we were LPs. So really, it's very much a relationship business. You really need to meet not only vendors, brokers, but you really want to network with other operators as well, because one day those operators could in fact be sitting across the table from you making decisions on the same GP team. So we attend a lot of seminars, stay up on best practices, and really try to hone in on the expertise of other educators within the space in order to leverage their knowledge. And in doing so, we believe that that brings a reduced risk to the investments that we try to put out to our investor database, in order to, just have more sets of eyes, more experience, just staying up on, the current rest of the market and passing that along.
All right, so these are some key investment strategies in multifamily. So I'm just going to outline these. So the first one is core, which focuses on stable income producing, well-established markets. Think like New York or Los Angeles. These are lower risk, but they're also lower returns. The next is value add, which is where we do the bulk of our investing. So value add are properties that require improvements to increase the value and the cash flow. And then there's the opportunistic investment, which targets distressed properties. These are higher risk, but oftentimes higher risk, higher rewards.
Yeah, so right now, opportunistic and distressed, that's something that's been thrown around a lot. When people talk about distressed, they think, like Detroit, or they think 2007, 2008 in the residential market. Now, what's currently happening in multifamily, just the state of affairs, there is a lot of distress, mainly due to the type of debt that operators were able to acquire a couple years back. And because they're not able to meet certain debt service coverage ratios at this particular point in time, there is going to be a lot of movement within the next 4 to 6 months. One industry expert put that number at about 2,500 properties that are going to have to potentially change hands or get recapitalized. And those that can't get capitalized are, they're going to have to scramble. So the opportunities here, we're right in the middle of it. People have said that the value of some of these properties has decreased from its peak by about 36%. So will these properties, will they get further, distress as far as price wise? Maybe by a couple percent, but there is a ton of money that's been sitting on the sideline. Private equity has been putting pools of money together in order to take advantage of some of this distress that's come. I think we're going to see a lot of this starting to move around in 2024 into 2025, the likes of which we haven't seen in a few years. And so that's really one of the reasons that we wanted to jump on and just bring some people up to speed that aren't familiar with the space on some of the basics, really just educate people on the opportunity that's really in front of us, because I think that the time is really coming up to take advantage of this. So it's really important going forward. As I mentioned, the type of debt that people were taking on before was bridge debt. Right now, the debt of choice is obviously agency debt. There are benefits and negatives with both. Obviously, with the bridge debt, it was buying the right rate caps and being able to meet that debt service coverage ratio. In agency, it is the yield maintenance on the back end. So the ideal scenario would be a step down prepayment penalty that is, not going to wipe out your business plan. And really just, you have to look at each individual property. You have to look what the GP team is assuming, and is that feasible? Is that something that is achievable? And those are all questions that you should be asking yourself going into any investment or getting with any GP group that's looking to acquire going forward. So I think this is one of the most important slides. It's really the market analysis and due diligence. Due diligence being paramount, really. We're constantly trying to stay up on our markets, market trends, demographics. One industry expert that we follow, says that real estate's not, local, it's uber local. So you really have to know what's happening, what sides of the street are being developed, what's coming there, what businesses are moving there. Really just having a good understanding of what's happening in that local market. When we look at these properties, we really want to assess the physical condition, not only look at it, but know what to look for. So, we try to get our whole team. We walk every unit. We look at the inner workings of these buildings. We look, not only on the HVAC systems, but the roofs, plumbing, sewer. We look under it like with a fine microscope. So we try to really get a good assessment going in. Same thing goes with the financials. We do file audits. We look at criminal background, credit worthiness, income, and we want to make sure that those match what the outgoing property management company has on file for our particular tenants. A lot of times these properties will get let's say positioned for sale, and there is a certain amount of loss to lease that happens. It's industry understood that you'll have to go in and clean up the books a little bit, but some people kind of lean on that a little bit more than others. So we as a team, we go in there and we look at these things, and we really try to get a healthy assessment of what we're looking at going in. And then also there's legal aspects. So we've come across properties before where, let's say, certificates of occupancy were what they portrayed them to be. So over time, we've come across older property, especially in the workforce housing aspect of the industry. People have taken bigger footprints and maybe they bootlegged an extra, unit or two. And so these are all things that you have to check and just make sure that if there was any damage, that things were built back, that there's no liens on the property, and just kind of go through it very systematically in order to, have everything check out through your due diligence period. So really going forward, the financing and the capital raising, I think these are paramount. The biggest part of it, I think, is the financing. If you get the right debt, there are definitely discounts in the market as far as prices that you'll be able to acquire these properties. I do think when rates start to come in, I think you will see potentially bridge debt becoming popular again. Right now, the only people that are using bridge are people who have very strong financial balance sheets and also good working relationships with lenders. So for the most part, everybody has moved to less leverage, less risky agency debt. But I believe that there is let's say, a race to find capital as well. As I mentioned, there's lots of private equity money that has been established on the sideline for the opportunity to pounce, and I think that time is here. As far as syndications, there's a lot of syndicators, us included. We've been operating within the syndication space, but we believe that we would be more competitive with having a fund and having the ability to have indications of interest, signed subscription documents to be able to go in and acquire these properties and really be able to give our investors a little bit more surety not only on their deals, but surety to close, diversification across multiple properties.
So John was asking here, just real quick, does everybody know the difference between bridge and agency debt? So I'm assuming not. So maybe if you want to just elaborate a little bit on that.
Yeah, so the agency is basically Fannie and Freddie. They're the biggest lender in the country. And bridge is essentially short-term lenders, hard money loans that are known in the residential space. And they're known as bridge lenders in the commercial real estate space. So in this space got really popular with the bridge lenders just a few years back when deals didn't really pencil with the amount of leverage that you were able to take on a multifamily property. So with bridge lending, it allowed you more leverage. So you could basically finance your business plan or your CapEx for these properties 100%. And so now what happens is you have lower leverage and GP groups will have to essentially go raise more money, which is a challenge right now with the cost of everything else going up. There's a lot of people just from the residential or a retail investing space that, they're a little bit more challenged to be able to come up with investing dollars. But right now is an absolute great time to invest in this space. So we're really excited over the next 4 to 6 months. We're constantly underwriting and looking at deals. And I think really, it's not about how much are we going to make on a deal, especially when times get a little bit more challenging, but how are we going to mitigate risk? That's what a lot of the big investors look at before they find out the upside. So really, when it comes to risk mitigation, what we try to do, we talked about diversification from an investor standpoint across multiple properties of multiple class types. But we also go through our due diligence. As I mentioned, we try to really, look at everything with a fine-tooth comb and try to uncover any pitfalls that may arise before really having to lock in on a property. We try to go through a robust financial analysis, looking at everything from, credit worthiness and financial, their income scenario. We really want to get, a good understanding of our resident base. Also, the effective property management is huge. It's like I said, it's a people business. It's all about communication, and sometimes we try to take on the role that we want to give the outgoing property manager the benefit of the doubt, but sometimes what they say, what the financials say, and what residents say, they don't always add up. So we try to check but verify. We should always have a contingency plan because it's not a matter if something goes wrong, it's a matter of when. In life and in business, there's always going to be a little bit of a hurdle. So the biggest contingency plan that I could really hope to have is the right insurance, and not only the right insurance. Sometimes property managers will be able to do a larger, more robust insurance policy across our portfolio. And as asset managers, we've also looked into some master policies, not only with our properties in a specific demographic, but also with other operators that might be in a specific demographic in order to get some more efficiencies. And really, it's about monitoring all these things that could happen. These entities are living, breathing entities. There's people moving in, moving out. There's vehicles coming and going all the time. So anything can and does happen. And it's really, monitoring and adapting and making sure that the rest of the daily business and business plan stays on track. So really, right here, what we have is a Class B, classic garden variety property that you would find in the Dallas area. This is a 3-story. A lot of people like the 2 stories. They're not making more of these. When a developer comes in and makes new properties, they're building a Class A property. It's designed for a totally different demographic, but we just like a nice, clean, boring property. A boring property is a sexy property to us. That's an exciting property where there's not a lot of pitfalls, and not a lot. It just operates, and that means some less headaches for us, and it allows us to focus on some other things in order to really push that NOI on these investments.
All right, well, that pretty much concludes our presentation for tonight. I said that we wanted to try to keep it between 30 minutes, 40 minutes, and I think we're right about there. So I know Michael went over a lot of concepts. We talked about benefits of multifamily. We talked about multiple streams of income. We touched on the legacy wealth aspect and all the components of acquiring these properties, the due diligence that's involved, and all of these details. So multifamily investing, it's really a powerful way to create multiple streams of income and build legacy wealth. It offers financial security, and when approached strategically, it can provide financial independence and opportunities to leave a lasting legacy. So thank you so much for joining us. We really appreciate it, and we'd love to chat with you. If you have any further questions, if you'd like any further information on what we talked about tonight, or just want to get to know us and what we have to offer, feel free to scan this QR code. The QR code leads directly to our LinkedIn, or I'm sorry, not our LinkedIn, our Calendly link. So you could book a call with us. We'd love to chat with you. You can also email us. Our email address is right here on the screen. It's connect@flowequitypartners.com.
Thanks for joining us this evening.
Thank you, everybody. Have a wonderful evening.